A solicitor recently called me asking for clarity on the 10-year and exit charges on trusts. That conversation made me realize how many families and even professionals find this confusing. So today, I'll explain exactly how these charges work, including what happens with 18 to 25 and disabled beneficiary trusts. Hello, welcome to today's video. My name is Dora, and I'm a Chartered Certified Accountant and fellow tax advisor here at Grace Certified Accountants. Now, before we continue, can I please ask you to subscribe to our channel for more property tax tips and advice? And if you know of other people that you think will find this information useful, please share with them. Thank you so much. Now let's continue. Let's start with the basics. When you set up a trust, for example, to hold property or savings for your children, inheritance tax doesn't just stop there. Every 10 years, some trusts face a 10-year charge, officially called a periodic charge. It applies to what's known as a relevant property trust, such as discretionary trusts or certain interest in possession trusts. It's the government's way of keeping trust-held wealth within the inheritance tax system. The maximum rate is 6%, but in most cases, the effective rate is lower. Now, here's how it's worked out. Value everything in the trust at the 10-year mark, deduct debts or liabilities, subtract the new rate band, currently £325,000, and then apply the 6% rate on what's left. Here's an example. A rental property in a discretionary trust is now worth £500,000. After using the new rate band, £175,000 is taxable. At 6%, that's a maximum of £10,500 due, though it's often less after calculations. Now, what about when assets leave the trust? That's where the exit charge comes in. It's a smaller charge that applies when money or property is distributed to a beneficiary. It's based on how long since the last 10-year charge and the same 6% but scaled down. So if a property worth £250,000 is distributed 5 years after the last charge, only a fraction, often under 1%, is payable. Parents or grandparents often use this to help young adults. The 10-year charge doesn't apply if the beneficiary becomes fully entitled before 25. But if funds are released between the ages 18 and 25, there may be a small exit charge. Here's an example. A trust pays $200,000 to a beneficiary at age 22. Because it's before 25, there's a minor exit charge, far less than 6%. Now, trusts for disabled people are treated more generously. Now, if the trust qualifies under the Section 89 of the Inheritance Tax Act 1984, it's exempt from both 10-year and exit charges. The main beneficiary must be in receipt of certain disability benefits or be unable to manage their own affairs. But if other family members also benefit, the non-disabled part of the trust may still attract charges. Now, if you have been watching so far, thank you. I appreciate you staying with me. Can I remind you to please subscribe to our channel for more trust and property tax tips and advice. Thank you so much. Now let's continue. Now here are some planning tips. If you're a trustee, keep clear records of the trust deed and creation date. Get up-to-date valuations before each 10-year mark. Record any distributions clearly. Remember that one new red band can be shared between multiple trusts by the same settler. Now the key point is this. The 10-year and exit charges are not penalties. They're just part of how inheritance tax is applied to long-term trusts. But most families don't realize when they are due or how to plan ahead. Now, if you'd like help reviewing your trust or working out whether these charges apply, you can book a trust and property tax review with us here at Grace Certified Accountants. We'll go through your trust, explain any potential IHT exposure, and show you the best way forward. I'm Dora from Grace Certified Accountants. Please remember to like, share, and subscribe to our channel for more property tax tips and advice. Thank you so much for watching. I'll see you again soon.